Okay, welcome everyone to this monthly webinar in August 2010. Um, this will be a two-part webinar, as you know. First part and second of 1.5 hour length. And very pleased to see so many people here. I thought because of the vacation period, we would be far less people here, but I see that we are a fairly big group. Let me just ask, have you been to my last webinar, the one we talked about this strategy design? It was called Converting Ideas into Tips. Yeah. Okay. Yes, I remember some of you. Fine, because in fact, the idea to do this monthly webinar was yours, since the material that we had for the regular webinar last time was a bit too much. So we were a bit in a hurry in the final part. So we couldn't really get into details with everything. So the audience proposed to host a monthly webinar and extend the subject, and that is what we are going to do. So basically, this first part will be very similar to the last webinar, converting ideas into tips. Let me just let's do the link. This is the link. This will be it's my first monthly webinar with you, and I hope we will enjoy it together. So let's start. We will talk about how to build a mechanical strategy. The idea to teach you the subject, cover this topic, is because it's an essential step in the learning process of any trader. Does not mean that a mechanical strategy is in itself a trading model or a trading plan. It is just a part of it, and so I would ask you to adjust the expectations towards the topic, in the sense that we should not expect that a mechanical strategy will solve all our needs in terms of our trading career. Okay, it's just one of the steps, and since we are going stepwise moving forward with my webinar series, this is still one of the basic ones. Okay, but yet very important, how to design a complete strategy. And we'll start by designing a mechanical one that we can replicate, one that we can verify, that we can back and forward test, and one that we can easily teach and transmit. And the idea of a mechanical strategy, or the definition, would be a set of rules which don't allow any subjectivity or second guessing. Okay, so it will be a strategy that once transmitted to you, you will execute it exactly the same way, because it's very mechanic in its design. So the webinar will be structured in a brief recall on the last webinar, and in that case I would say on the first webinar, the one we talked about what we call the inventory. Then we will properly design a strategy. We'll do it from scratch. We'll start with some very basic concepts, and we will go moving forward step by step, choosing tools and measuring the concepts on which we want to to capitalize to finally have the strategy fully constructed. Then there will be a brief moment to exchange some links and references, and I hope that this time I guess we surely will have time for a rich question and answer session. Okay, so I will do things in a way that we really can get more interactive here. Okay, the brief recall on the first webinar on the inventory, what we call the inventory, is in that first webinar we just went through a list of ideas, of concepts, which we as traders may find along the way, things that we may observe in the chart, things that we may hear from others, what others are doing, how other traders or analysts are reading the chart, how they understand the market. All these ideas, what we think the market is, how we believe it works, and all these ideas and concepts, beliefs, and so on. We found a way to list them on something that we call the inventory. An inventory, the word itself is usually used in where you have a stock of goods and you make an inventory in order to know how much goods you still have, how much goods you sold, and so on. So periodically, a manufacturer or a wholesaler will make an inventory to see what is still in the warehouse and in stock. So in that case, in our case, the inventory is a more mental thing. It's a list of ideas that we have, things that we found, things that we identify with, and that can help us to further enrich our trading, our methodologies of the way we trade, and also, and that is why we started with it, the way we design a strategy. That is, we will start designing a strategy, not starting with a tool, not starting with an indicator. We will start designing a strategy from something we observe. Okay, something that we believe in. Okay, so this is we will see how and why it is really important. Okay, and basically the process that we will see, starting with the ideas for here. This is a kind of cycle where we move from the concept world into establishing and formulating a hypothesis, which we then are able to measure to see the potential that there is, and finally we choose the most appropriate tools to capitalize on that measured hypothesis, and then we finally go into choosing the time frame and also the rules and conditions that we may design as an essential element of any strategy. Okay. This circle that we see here is in fact composed also of smaller loops, smaller inner circles where you once you choose a tool, You want to you measure an hypothesis, and if it doesn't work, you choose another tool and measure it again, and the same with a time frame, and the same with the rules and conditions. You go back and forth, making smaller circles within the bigger one. Okay, then you verify, and along the way, many ideas will arise, and we'll see examples of that with our strategy. And those ideas go and observations and so on go back into the ideas into the inventory that we had, because it will further enrich and the whole circle. Okay, and then the final purpose of any strategy is obviously to accumulate pips in the market, and but still the process is not over. We have to monitor it, and also during the monitoring process, we may discover new things that will enrich the strategy. Okay, so each one of these steps is a world in itself. Requires a proper knowledge, and we will cover all of this, and not everything in this webinar. We will go probably around here, the verification, the rules and conditions of verification. Okay, we will not talk about monitoring. This will come in a later session, but this is more or less the path that we will follow. Sorry, just did something wrong here. Okay, the definition of a strategy. Just a brief note on that. A strategy, the way I understand it, and my heritage comes from having a background working with automation, not probably on a programming side, but on a monitoring side of a strategy. And those of you who are into automation will probably agree with me that the definition of a strategy is one pair, one time frame, one set of rules. Okay, that is technically especially from an automation point of view, that is the definition of what a strategy is. And yeah, if you change the time frame, if you change the pair, then you have a different strategy. And if you bundle them together, then you can speak of a trading system. Okay, this is just a brief note. Because sometimes we will talk about strategies, sometimes we will talk about systems, or even trading models, and I have a different definition for each one, for each one. Okay, because when we think of a trading system, this is probably the word that is most used, trading system. But what is really meant by that? Okay, what amount of rigor do we apply when we talk about systems? Okay, because the problem from my point of view when we talk about trading systems, it lies within the word itself. The word system implies in our understanding something that is systematic, right? So when we hear talking about system, we think about something systematic, something mechanical, something where we don't have to guess, we don't have to think about, we only have to execute. Okay. Once I heard from someone telling me, I am a disciplined guy. I only need a trading system. If I have a trading system, if I would have a trading system, I could follow it because I have the discipline. If the system says buy, I could buy. And if it says sell, I could sell. Okay? But the whole understanding here, the whole thought process that is behind this affirmation is wrong from the bottom. And one of the reasons we get into wrong thinking It's because of the wording that we choose and the connotations that it has. Okay. So if you say, for instance, I only need to find a trading system in order to be profitable, the whole sentence will drive you nuts, because first, if you say find, that means that you have to search. Okay, so that doesn't mean to search, doesn't mean to research, doesn't mean to develop. It means to search. It's to look outside of yourself and to search. And the second part of the sentence, the trading system, makes you think that by searching something, you can stumble upon something that is mechanic in its nature, and that will do all the work for you. Okay, so the whole sentence, I only need to find the trading system, will make you lose a lot of energy, a lot of time in your career. So that is why I put some importance in the way we choose the word, and I like to question the definitions that we have, the personal definitions that we have for the wording for each concept, because we may not be aware, and something maybe may take us a lot of time. Okay, so here I write a trading strategy is a set of rules that generate buy and sell signals without any ambiguity. These signals are mostly generated by technical indicators or combinations of technical indicators. Okay, this is what we call rules. The primary aim of a trading, in that case, system, is to manage risk and to increase profitability in a specific instrument and market environment. Okay, so the approach that we have today is to design a strategy which generates buy and sell signals without any ambiguity. That is our proposal. Okay, this is what we call the inventory, what we talked about in the first webinar of the trading plan series. It says once you are able to explain how the market works from a personal perspective, then you can elaborate an hypothesis. Capitalize. Market observations are thus the building blocks of every system and trading method. We went through a list of more than 10 observations in the list, and the inventory can have anything. Can have it during a specific market session, or you can observe some correlation or some curious behavior in the candles, for example. There are a myriad of things. You may observe that if you are on an hourly chart, for example, and the hourly candle is about to close, you see how this candle get nervous at the close of the candle. You may find it curious and interesting for further research, and you put it on the list. So the inventory is not built of trading rules or tools or ready-made signals, but it's more a conceptual thing. You may also include in the list that you find out that you behave much better in the morning than in the evening, or vice versa. So there you have something important that will condition your system design. Okay. You may also have an idea of the market being a cruel monster. So I think you should put it also on your inventory list. Okay, if you believe that, because it's something that you should some time along the process. It's something that you should reconsider if you are uh, um, trying to perform in an environment that is hostile for you, that is a monster, that is cruel. Okay, at some point you should think about that and reconsider that belief. Okay, so the inventory may have all sorts of concepts, observations, and so on. And among that list, we for the current exercise to design trading strategy, okay, we draw just two ideas from that inventory. Okay. Abel asked me if I have a sense. That is what we are going to see. That is what we are going to design, and we will result mechanical backtested results, and especially in the second, and we will go over some charts. But the rules we will talk about them during this first part. Okay, so we'll see the complete process as I show you in the diagram before, where we get to the point where we verify that the strategy. So we will see the almost the complete process. Okay, what are the ideas that we draw from our inventory? The first one being, I observe that most daily bars or candles break the high and or the low of the previous day's trading range. Okay, a very simple observation, very simple. Okay. The second one, I observe the biggest volatility and price movement occurring during the European and first half of the American session. Okay. Also something that is almost obvious, you should say. Okay. I mean, is it worth to put on a list something as basic as this, that most daily bars break the high and or the low of the previous day's trading range? This is something that everyone knows, that everyone sees. Yes, everyone knows that where the biggest volatility is. But how many people make the effort to capitalize on that? How many people make the effort to measure the potential of that and choose carefully which tools are the most appropriate ones to capitalize on that? Okay, and we could go on, and the number of people will reduce. How many people will be able to formulate rules on those tools, with those indicators, with those combination of indicators? How many people would take the time to test it? Okay, and how many people would take the time to verify once line in real time, verify and fine tune, and so on and so on. So we see that the key here, that the point is not of being original or finding something that nobody knows, but the way to process an information that everyone knows, but only few are making something about it. Okay. So here we see a chart where we see those potential breakouts. Okay. I've zoomed these the price action you see here in this ellipse form. I zoomed it a little bit, and you see the obvious, that most candles break above and below the previous day's candle. Okay. Most of the time it happens. Not always. For example, we have this candle here, which doesn't break. By the way, Do you know what is the technical term for a candle that doesn't break the previous day's candle, the previous period candle? You know the technical name? Inside bar, correct. The Western technical term. Okay, it's important to inside day. You are on a daily chart. It's important to get familiar with the right technical terms. It allows communication, and it allows us to be rigorous about what we do. Okay. You know that I mean, if you go on some academic circles, technical analysis sometimes it's still seen as a bit of hocus pocus, and but fact is that technical analysis exists for at least 300 years. We know from the first intent of forecasting price movements. Okay, and a lot of people have worked in different areas. There are a lot of different branches in technical analysis, and it's a very serious study, and it deserves some attention. It deserves rigor, and that is why I find it interesting to have always the proper definitions for things. So here we see that the breakout is something that we see most of the time. In fact, we see if you go through this daily chart on the Sterling, you see that most of the candles break the previous candle high or low or both. Okay, but how many times is there a breakout, and of which magnitude? This is something that we will measure. Okay, and the second idea concerning the sessions, the market session, we see on this chart here that most of the action really happens during European and first half of the American session. Okay, this is an idealized chart. Obviously, when we do webinars, we usually choose idealized charts and situations to show the concept or the idea. Well, I will try not to do it when we are coming closer to trading. But for this purpose here, I choose the chart where we clearly see that the moves are restricted to some part of the day. So that is the part of the day we want to capitalize on. Just to answer to Alper who asked, so for this example, you also choose the time frame as 1 day. That we will see. We will see that. I can tell you in advance that the strategy is an intraday one. It's an intraday strategy working on a 60 minutes. But there was a reason for choosing a lower time in the daily. Okay, the initial observation comes from the daily chart. That's correct. But the chosen time frame to work is a minor one, a smaller one, by a degree of 24. So we went down to 60 minutes. Okay, and I will explain. Pardon, I'm just clicking the wrong button. There is a reason. There is a reason for it. Okay. So here, once we've drawn these two ideas, we start to establish an hypothesis. Okay, the magnitude of the breakout differs from candle to candle. This is also something that we observe. It's not always the same, but many times the distance the price shoots off the previous daily extreme is large enough to be considered a profit potential. Therefore, I want to capitalize on the breakout. Okay, so I observe something and I say I want to capitalize on those breakouts. Okay, so preparing the hypothesis requires you to actually see on the chart if there is enough evidence that a specific action-reaction pattern regularly happens. Okay, this would be the first or one of the basic steps in before considering what tools or what rules to design. Okay, so we want to see something happen regularly, and every one of us will see different things because our perception is wired in a different way from person to person. Okay, I may see breakouts, but another person may see easily or will more easily detect reversal or ranges when price gets starting to arrange. So the perception and perception is different in every one of us. Also is different from person to person and will condition finally what you observe and what hypothesis you will be able to capitalize on. Okay. Boyke is asking if I can explain GMT day time frame. Not sure what is the point here, but the time frame chosen to the time window chosen is correct as Tank is answering from way 8 to 17 GTM. That is the time window we finally choose to capitalize on those breakouts. Okay, so Sand is right here. That is our time window, and that is GMT, pardon, GMT, yeah. So even if you you are in a different time zone, so you would try to follow or to test the strategy in that time frame. But again, the time frame or your availability regarding to the moment of the day or the week to trade is also something that should go into the inventory. If you say in my time zone I can't trade the opening of the European session, that's okay. That's finally that's absolutely okay. What is dangerous to do is to try to fit a strategy which capitalize on a time window that is not natural to you, that you try to make it yours, because then you have a conflict here, because you will it will be a cost of sleeping hours for you. Okay. Yes, Boyke, London and US sessions, especially the first part of the US session. So 17 GMT will be the close of the time window. Okay. So in that case, I'm located in Central Europe, so for me it was okay to develop the strategy within this time window. But if would be living in Asia, in the Azorean island or wherever else, then probably would have come with a different strategy, okay, and a complete different setup. Okay, so at this stage we start to measure. We start to measure that hypothesis. Okay, so once you have enough evidence that the recurring action and reaction events takes place on a regular basis, and you can measure the potential. For example, in this case of the breakout, okay, during 2005, that was more or less the year when I started designing this strategy. During 2005, The average magnitude of the breakout was 65 pips in the sterling dollar. 92% of those breakouts were above 10 pips. 38% of them were above 65 pips. And still almost 20% were above 100 pips. Okay. As for the frequency, how often it happens, the pair, in this case of the sterling dollar, broke out 88% of the time that year in 2005. So we have a frequency of 88% of the time there is a breakout. 88% of the trading day you see a breakout. Okay, and you have a magnitude of this breakout that is fairly interesting in the sense that 65 pips, for example, which would be a mean, and in the scaling of magnitudes and percentages, we have 65 pips. Okay, and still there is 19% which is above 100 pips, which is also interesting to capitalize on. Okay, 20% of those 88% of trading days are breakouts above 100 pips. Okay, that initially that gives us an idea if our initial concept, if our hypothesis is worth to capitalize upon. If it's worth to start choosing tools and establishing rules to capitalize on it. Okay, and the fact is that these first measures, well, the numbers are not bad. There is a potential. So this first step is important in the sense that if it comes out that the magnitude is poor or the frequency of the occurrence of that event is low, then we would not go further. We will draw 2 different or 3 or 4 or whatever concepts from our inventory, and we'll try to measure them. Okay, and that is a step that is often just well, not considered. We go straight to the application of the tool in real time. So we see how an indicator works, as in explained in textbooks, and we'll try to use it. And the fact is that, well, indicators are made for that, are made for print signals, but that is not exactly what we want. Okay, there must be an idea behind on which you want to capitalize, and that idea has to come out of our perception, in order that the whole design of the strategy will make something that is really a continuation of my mind. Okay, I want something that is really personal. Even if I haven't been original here, I haven't found anything new. I mean, probably the rice traders in Japan, when they came up with a candlestick way of visualizing prices, they already knew that prices break the highs and the lows of the previous period. So I'm not finding out something new, something that is very, very old. But still it has to be something that I personally identify with or understand. Ben asks if do we place the trade only on a daily time frame on the sterling? No, as we will see when coming to the time frames, we will use an intraday time scale. Well, Abel asks, how do you measure or define the frequency? And he asks again, if I observe it every day. Well, the thing is, we have historical charts, right? And that means you can go back you can go back in the chart, back in time, I mean, and you can measure it. You can measure it manually. That would be the most well, not simple, but accessible way, at least to measure breakouts. I mean, you can go you can go to charts, or you can just take a price series where you have the open, high, low, and close. Okay, and so you will always take the previous day's high and low and see if there is a difference to the new high and low of the second day. So you can measure that difference. Okay. So there are softwares also who measure this and other things. But if the concept is simple, you can just do it manually. Okay. If you trade, for instance, divergence. Okay. If you trade oscillator divergences. Okay. You may say, okay, I identify with the concept of divergence. I find out that I prefer the type of reversing, of reversal type of strategies, and I like the concept of the divergence indicator and price. So let me see how many regular bullish and bearish divergences occur in the sterling dollar on the 60-minute chart per year. Okay, how many divergences? Okay, so and you can count them. You just go back in time. You apply an indicator in that case, because you are taking a concept that includes an indicator. Okay, so you just scan the chart and find out the frequency. But this is something different than testing. Okay, just scanning the chart, and especially if you don't take note, if you just do eye scanning, this is not a back test. This is not a serious test, because our eye, if you are interested in a specific setup, your eye will see those setups, but it will see especially those that work out. And it may appear that, wow, boy, that happens all the time, and it works mostly all the time. But if you do a rigorous test, a back test, a forward test, then you probably discover that either the magnitude or the potential was not the same as you initially saw. Okay, because this eye scanning is something that we can do in the very first stage. But then we have to really roll up our sleeves and start working a bit more seriously. Okay? Because our mind will always try to identify what we are looking for. Yeah? This is something that we probably can't control. This is our nature. That's why there are tools to backtest and to measure and so on. Okay. Otherwise, we wouldn't need that. Okay. If we look to a chart and we see the complete potential, if you can see all the statistics just by looking at it, then no indicators would have been developed, because indicators, technical indicators in that case, I mean, are ways to visualize charts in a different way, so that we don't have calculate. Okay. Okay. Let me go through some questions here. So we answer to Abel. Harley asks, but you are only glad to get a piece of the breakout, not the whole move. Correct. Yes. Yes. I'm happy with that. I'm happy with that. See, if we take the price, all the ups and downs on a 1 minute chart, okay, during 1 year, the resulting peak oscillation, peak move, okay, that would be huge. It's like a coastal line. When in math, usually in geography, there is a concept. We know it's the length of the coast. Okay, we know each country. If there is coast, we know how many kilometers coast there is. But that coast is not measured centimeter by centimeter. You don't go really there on the seaside and measure each stone, centimeter by centimeter. Otherwise, you would have a coastal line that would go several times around the planet. And the same is with price action. Okay, price moves a lot. It oscillates a lot. So I'm happy to take a little bit out of it. I'm happy with it. Okay. So what besides just to answer to Harley here, besides there is when designing a system, there is a concept called the favorable excursion. Okay, the favorable excursion, which is the amount of peak movement that is produced once there is a signal. Okay, once you have the signal or the occurrence, in that case the breakout, you have a favorable excursion. Okay, before the price comes back. Okay, and that is also a measure that is used in system design. Okay, but usually traders are happy with taking part of it. Okay, let's move on. There is Harley also suggests to use the ATR for this measurement and so on. All very nice ideas here. We will also see an answer to Joker's question how we handle false breakouts and pullbacks. Okay, we'll see all that. So okay, we have so we are now at the measuring of the hypothesis, and we'll start by choosing our tools. But first, we need to analyze what are the proper conditions, the conditions that we need to see in order for those breakouts to develop their potential. Okay, and in that case, the market conditions we need are an increased momentum and volatility in the market. Okay, breakouts are in that case associated with its qualities. Okay, and we need a major underlying trend in the direction of the breakout. Okay, this is a trend following characteristic here. Okay, so before we start to choose the tools, we analyze the conditions. What are the best conditions that we want to see in order to capitalize? What are the conditions that we see in those days where the breakout has a bigger magnitude? Okay, so this will condition obviously the kind of tool. Okay, already we are talking about momentum, we are talking about volatility. Okay, we are talking about trend. Okay, this the conditions would be different if we would be capitalizing on a reversal, for example. Okay, then we don't need especially an increased momentum, increased speed, or an underlying trend. We would need the opposite condition. Okay, the conditions determine what tools we finally need. Okay, so generally speaking, pieces of a strategy. Okay, any objective trading method should encompass several functions in order to capitalize on a hypothesis. Its basic setup should provide specific rules for determining, and this is something that every strategy would need. Okay, identify if there is a developing trend, developing reversal, or a range. Okay, and its scale, its short, intermediate, or long term. Okay, we also need the direction of the movement. Okay, if it's upwards, downwards, or sideways. Okay, so we have to start to think now about what tools tell me there is a trend, or there is a reversal, or a range, or what tool can tell me what is the direction. Okay, what tool or condition, because in case I may extract that information directly from price action, or I may use an indicator. Okay, we have here a very technical approach, but I may think also in including other types of analysis, fundamental analysis, or other types of less known types of analysis in order to cover these requirements. Okay, but for sure we need to know the direction, because finally we'll need to buy or sell. So first we have to have something in our strategy that gives us that information about the direction. Okay, and then obviously an essential piece of a strategy is obviously an exit level to avoid large losses. Okay, and an exit level to take profits on favorable positions. Okay. Besides, there is the optimal time to be in the market, which is also a piece of the strategy. Okay. So the tools needed in our case, we need an indication that volatility is increasing. We need, in order to verify to identify the underlying trend and the direction of the breakout, we need something to estimate the magnitude of the movement. So the question that we had before, that we just take a piece of that potential. We need a tool that measures that potential and part of that potential, okay, within our measures, the measures that we did before. Okay, within that measures, we need a tool that will give us a number that is within our average magnitude. Okay, so and finally, in order to set an exit level to cut losses, there should be also a rule or an indicator. Okay, so first we know what we have to know what you need, and then choose the corresponding tool. That would be the thought process. Okay, we are here still in that phase where before we choose the tool, we already have those characteristics that the tool should encompass, the tool or the rule should encompass. Okay, and then we choose the corresponding tool. Okay, then obviously the time frame, and here we come to the time frame, and in this case it's advisable to experiment with different time intervals, because an hypothesis may work better on a small time frame than in a longer one, or vice versa. Okay, and the findings here with this strategy was that the 4-hour time interval and above, the daily as well, were too high to capture the breakout. Okay, in any time frame below 1 hour may generate unnecessary signal. So that is how do you find it out? What's the best time frame? Well, this is something that obviously you have to start with something. Okay, probably I don't know. I can't really remember back in 2005 in which time frame I started, but I probably started with a daily, and starting to once I measured it, I started to try to find indicators for those characteristics that we just spoke about: volatility, a surge in momentum, and the underlying trend and the direction of the movement. But I'm sure that I quickly found out that any technical tool applied to the daily chart was too lagging, was too slow to give me that information. So I had to go into smaller ones. Okay? And I probably went to the 5 minutes, back to the 5 minutes. But once I'm capitalizing on a daily breakout, 5 minutes is really a small fraction of information that is, or a potential that is extracted from the daily. So finally, I found the 1 hour. But this is where these inner loops take place, where I test the time frame, and I realize a few facts. I include those observations in my inventory. I choose another one and test. So there is a movement forward in the whole circle of strategy design, but there are smaller loops inside this circle, back and forth, in regarding to find the most appropriate tool. Okay, so I start with the first round of tests, obviously, and well, in this round of tests, there is you already start to plot the indicators you think that may be appropriate to give you the information you need. Okay, and this first round of tests, what I usually do, I just have a pen and paper on my side, and I take note of everything. I take note of everything, especially things that are occurrent, that occur a lot of times. So I take note of that, and from those observations, you start to formulate your rules. Okay, till the optimal levels of risk and reward are also are found by modifying the different parameters within each rule. Okay, but this is something that, again, it's not a linear process, and we will see exactly at which stage of the design I included different rules. Okay, so in that case, it's recommended to start with a backtest. Okay, and if it is not possible to go back in time and to backtest, then a forward test. Okay, the difference between a backtest and a forward test. So basically, it's in a backtest you work with historical data. Okay, you go back in time, and you apply the rules in the market, and you have because you are working with historical data, you have the chance to run faster than in real time. Okay, the forward test would be real time. There are certain trading methodologies, trading approaches that are difficult to backtest, to test upon historical price data, because when you backtest, you do it on price data only. You don't have any other information. You could have information such as news, impact, or fundamentals, but it will be very hard work to do it. So backtest as I used here was purely with price data. Okay. In that case, the strategy was the type of strategy that I had was could be backtested. Okay. But if you are developing something on the 1 minute chart, which is very fast or discretional, then you may prefer to forward test. Okay, but especially if you for those of you who work on higher time frames, 4-hour daily time frames and so on, the backtest, I think it's the way to go, because you don't want to do all this process of designing a strategy and forward test, okay, just to find out that your strategy doesn't work, that you need to change rules, okay, because it also depends on the frequency of the signal. But if you have a strategy that prints only one signal per week, okay, the best way is to do a backtest, because if you have to wait for 100 weeks to get a statistical track record, well, 100 weeks, it's quite long just to find out that it doesn't work, that you have to change parameters and so on. So it would take years to finally fine tune the strategy, and in the meantime the market also changes. So you will never reach the point. Okay, so backtest in that sense is that is why it exists. Okay, so from this first round of tests, there are new observations that arise. Okay, so I observed that the magnitude of the breakouts are many times a Fibonacci extension. Okay, the 1618% Fibonacci extension of the previous day range. This happens well by just trying tools to measure. Harley mentioned the average true range, for example. This is one idea. Okay, I guess I think I tried to where I tested it as well in the first stages, but I finally I decided for the Fibonacci extensions, as I found out that many of those breakouts that were within that average potential very much were a Fibonacci ratio of the previous day's range. Okay, and so I adopted the Fibonacci extension tool. Okay, great. If I will have time to show a chart, yes, I plan to do so. Let us just advance. We will see some charts now, but not in real time. But later on, we will see some real charts in real time. Okay. So these are the tools that I finally used once I tested and retested again, experimenting with different tools. Okay. So initially a price box, the price boxes that you see here is just to mark off the high and low prices of the previous day. Okay, this is the 60-minute chart. Okay, there are period separators, and applied to this chart we see also the Bollinger Bands to 21 periods, and the simple moving average for 89 periods. Okay, and the tool setting, well, there is this combination of two moving averages, which is the combination which provides me the information I need to know about direction. Okay, the direction to go. Again, something again very simple. I mean, what is the most basic tool in technical analysis, or one of the most basic tools? It's a moving average, and one of the most basic uses of it is to determine trend direction, right? And the way we use it, we put it a faster moving average and a slower one, and the disposition of the two on the chart will show you the direction. Again, uh, something something very simple. Okay. I choose the period, the moving average period. I extracted them out of the Fibonacci sequence. Okay, since the 2021 um, uh, period, Bollinger Band is somehow of a standard in technical analysis. So at that time, I thought, okay, I will use the 21 since it's one of the numbers in the Fibonacci sequence. And now I need another a slower moving average. Let me choose a number of the same sequence, and I choose the 89. I just avoided to choose a mover average that were too close to the 21, so that I have really um, two indications of speed and of price processing. Okay, so that is clearly a difference between one and the other. Okay, in that case, the Bollinger Band, that was for me the indicator for volatility. Okay, that is the very nature of the indicator says it can be used for that, and it was made to measure that. So that the Bollinger Band practically it's based on the standard deviation. That means standard deviation is the amount of if you have a data series is the amount of deviations from that mean, okay, from that average. And the Bollinger Band is well, there are two bands that measure that standard deviation for a mean that is in itself moving, because it's a moving average. Okay, so since I wanted to use the Bollinger Band not for reversal, but I wanted it to encompass all of the price action. I just needed the band in itself to show me if there is an increased momentum or speed in price. So I really didn't need the Bollinger Band to obtain crosses between price and the band. So that is why I set the deviations to 3. Okay, so the Bollinger Band, if you set them to 3 standard deviations instead of 2, you practically have all of the price action contained within the band. Okay, since I don't need a signal, I don't need any other signal from the band, not the cross of the band, not the cross of the middle line. I just needed to create a sort of corridor of room for price to develop, and something that was sensible enough to indicate me if there is a surge in price. Okay, and that seemed to me the most appropriate tool. And as you see, at this stage where you choose the tool, here is where the knowledge on the study of technical analysis becomes important. And I believe it's more important to dedicate a bit of more time to understand the nature of the most common technical indicators than to experiment with complicated and sophisticated new indicators. Okay, because there are tons of indicators out there, but what we usually see is that the fully understanding of how indicators were made, how they are calculated, this is missed. Yeah, and the thing is that behind any technical indicator, there was also a measure, there was also an hypothesis, there was also a concept, there was also a personal inventory. Okay, John Bollinger, when he designed the Bollinger Band, he also had his way to understand the market, his personal market theory, let us say. Okay, he had his as well his inventory. Okay, and he wanted to capitalize on price movement. Okay, and but he wanted to represent price in a different way, a way that was more adapted to his to his way of seeing, of understanding price behavior. Okay, that is how tools are born, how indicators are made, because the people who made them had a need, had a need to represent price in a different way. Okay, to get an information that price is offering, but that is too complicated for our mind to process in real time. So a visual, so to say, a visual processing of price data. Okay, so behind each indicator, there is the whole story. There is a personal understanding of how markets work, and there is a whole process similar to the one that we are going through designing a strategy. So that is why it is important not to memorize the formulas. I don't know, maybe the only formula I could know is the simple moving average, which is the number of closing prices for a certain period, and you divide it by the number of periods. That's it. But I don't know the formula, exact formula for all indicators, but I've studied their nature, how for what they were made, and what were the ideas and concepts behind it, so that when I have a requirement based on an observation, I know which tool to choose, because it was probably made for that. Okay, so here we come to the enter rule. Okay, so the parameters to enter positions will be related to the type of system, whether it is a trend following system, a breakout, etc. The trade entry must be described in detail, including concrete definitions of the proper market conditions for entry and the final confirmation signal, also known as the trigger. Okay, so when we start to design the rule, here we should be able to write in a few words what the rule is to enter the market. Okay, because here we are already becoming specific. Okay, so at this stage we would be here and rules and conditions at this stage. Okay, and again, from rules and conditions to time frame, or rules and conditions to choosing the tools, or rules to even measuring hypotheses, there are loops. There are loops backwards and forwards. Okay, during inside the whole circle. This is more or less where we are now. Okay, so here we see a chart where we see the price box. Can you see my my pointer on the slide? Can you see the pointer? Okay, fine. So we see here the price box, and this is the period separator. So we establish that level as the breakout level. Okay. And here we have the next box for the next day, and we see indeed there is a breakout. Okay. Okay. The upper bound is expanding. So telling me there is a surge in volatility in this direction, but I'm out of my time window here. Okay, so this is not a valid signal. Okay, we'll go into detail on all this. We see that The 21 moving average, which is the middle line of the Bollinger Band, is above the 89. So the direction to go is only up. In those cases, we take only a breakout to the upside. Okay. So the next day we have here the high of the day. That's this line here, and we see we have a couple of piercings here. But why didn't we take those breakouts? Because the Bollinger Band is shrinking. That is the signal. Is the filter in that case that we don't have the momentum or the speed that the increase in volatility that we need to go for the breakout. Okay, so this is responding to a previous question of Joker from Germany. He asked, how do you handle false breakouts and pullbacks? So this is the filter. Finally, the filter that has to print us a green line. So the Bollinger Band on the side of the breakout has to be a parallel. I tested it, or I allowed a breakout if the band is parallel or is expanding in the direction of the breakout. Okay. And it has to be, the condition has to be there in the candle before the breakout, not during the breakout. Okay, because sometimes you have false breakouts on the candle before the breakout. The Bollinger Band has to be expanding on the side you want to go for the breakout, and the side, there is just one side per day. Okay, you choose to go for, and the side is determined by the disposition of the moving average. You go to the side where the shorter moving average is, the 21 in our case. Okay. So the long entry conditions are the 21 SMA is above the 89. Okay, trend in direction, and the upper Bollinger Band is not shrinking or pointing to the downside at previous candle. Okay, previous to the signal breakout candle. Okay. And the entry rule, the long entry trigger, okay, is when the exchange rate breaks above the high of the previous day. That is when we have the trigger. So the trigger here is price action derived, not from an indicator, but directly from price action. Okay, we just adjust what I did and for the backtesting that I will show you for the results I got is I adjusted a bit that the depending order to account for some pips more than the previous day high or low. So I account for the spread plus 1 pip. So that there is a bit of room for those tiny breakouts. Okay, remember that the scale that we did at the beginning, where we told how much percent of the days, how much pips it moved. So in that scale, we have breakouts of less than 10 pips. So I could observe in the first measurement that there were breakouts of less than 10 pips. So I want to have a rule or some tool that prevents me to enter those breakouts. Okay, it will help. It will happen. But at least I have something in the strategy that will cut some of these occurrences. Okay, and since they are very few, I'm comfortable enough with that. Okay, I know that per year there is a certain number of such tiny breakouts that I will enter because all the conditions will be in green light. Okay, and I will enter them and I will get stopped. But at least I have a way to cut them, and I know statistically what that amount of times more or less is. Okay, if I go out of statistic and in real time I see that it happens more times than my statistics, then I stop trading and I verify if there is an error. Okay. If I can go back one slide, yes, their long entry conditions are the faster moving average is above the slower one, and the upper Bollinger Band is not shrinking or pointing to the downside the previous candle. Okay, always the previous candle, and we always wait for the close of the previous candle to have all the conditions in green light before we place the pending order. Okay, so here we have the high of the previous day. Okay, and the entry level is slightly above it. Okay, assuming a sweet dip spread. Okay, notice how the Bollinger Band is already expanding before the price breaks out. Okay, the Bollinger Band is here with this candle here. This candle here expands the Bollinger Band only slightly, but that is enough for me to have green light to say I can go. I can place the order. Okay, all other indicators pointing to the upside. Okay, I can go. Okay, so this is a valid entry signal. Okay, for the exit rules, there are two types of exits. Obviously, there is a stop loss to get out of a losing trade, and there is a profit target to realize profits when the market moves in your favor. Okay, so we need this is where the Fibonacci tool comes into action for me to measure the potential of the breakout. Okay, the Fibonacci 1618 is always taken as the profit level of the breakout. Okay, and as for there is only one target. Regarding targets, there is only one target. So this is a very simple strategy where there is just one entry, one exit. Okay, there is no parceling of positions and or stacking or increasing size or reducing size along with it. This is not to say that it's better to work like this. In fact, after the years, I found out that it's better to control that position sizing a bit. Okay, not enter everything into in one time, or to exit everything one time, because then you get very dependent upon system performance. Okay, you have a bit of more control, but this is out of our context here, and it will take us to another topic, which is position sizing, and that is why I choose a strategy that is very basic in that sense, that it's one entry and one exit. Okay, so the target is just one, and the stop as well, and this is the Fibonacci extension. Okay, the exact take profit order will be placed a few pips before the 118 level, and if there is a round number closer than 10 pips to that level, we take the round number as a target. Okay, so round numbers are also a phenomena that is studied in technical analysis. You know, these are psychological numbers where a lot of traders take action, make decisions. So we don't want to waste a potential just because price reverses as a round number. Okay. Regarding to stops, well, the stop loss on a long trade in this case is placed below the 21 SMA or the 38.2 retracement in the Fibonacci scale. I put it here 68.1, pardon, as I have the tool, the Fibonacci extension tool inverted, but well, in fact it will be 61.8, I think. Okay, whichever is closer to the entry price. Okay, we'll see it in on a chart. Okay, conversely, stop loss on a short trade is placed above the 21 or the 618 or 38.2 Fibonacci level, the one that is closer to the entry price. This way, the worst potential win-loss ratio on every trade is a fee ratio. That when I discovered this, it was very curious, no? Because everything was somehow related to the Fibonacci scale. I choose the moving averages according to that scale, and then I found out that because I'm using the Fibonacci extension in order to take profits and to set my stop losses, I found out that the win-loss ratio, that ratio that measures the relation between the profit potential and the risk potential, is in itself a fee number. Okay, the fee number you see it here on the bottom, 16178, blah blah blah. Okay, it is just a curiosity, but it is a statistical data that is interesting to know. Okay, so another example here. At the moment of the breakout, we see here this square is the price box. This is the price box of the previous day. Here we have midnight. Okay, here we have the breakout. Okay, at the moment of the breakout, the 21 and the 618 Fibo levels are equal. So the stop would be placed beyond those levels. But since the movement is favorable, then I could trail the stop alongside the 21. Okay. In fact, this breakout is outside of our time window. I just took it as an example for a confluence between the Fibonacci level and the 21 moving average. Okay. Obviously, the Fibonacci level will stay there. It's a fixed level. Okay, because it's a scale, and the 21 will move. So if you want to trail the stop, you prefer obviously the 21. Okay. When I say here 61.8, in fact it's 38.2 because it's the way I plotted the tool here on the MetaTrader to show the slide. In fact, if we are considering this level as a retracement, what we aren't, it is the distance. It's 38.2% of the daily of the previous day range. Okay, just as a side note. Okay, the golden ratio, right, Upper? It's the golden ratio. So it was interesting to know that the win-loss ratio was a golden rate. Well, yeah, correct. Yeah, there are variations of the golden ratio, right? Are your trades long-term trades? Asked Harley. No, this is an intraday system. The trades are open maximum for 2 consecutive days, never more than 2 days. If target or stop isn't hit during the second day, then the trade is closed. The trade is closed at the end of the session, not of the day of the session. It's closed whatever it is in profit or in loss. Okay. So an advice for exit rules, I would say use more than one rule to enter the trade, but use only one signal to exit it. Okay? If you want to be faster, exiting a trade than entering it. So don't put a lot of filters in order to get an exit signal, but something that is very straight to get out. But in order to get in, there is where you want to put more filters. There is where you want to be more selective. Okay. So this avoids to have several indicators pointing out that position is wrong by adding rules and filters. So you choose just one rule, you are out and finish. Okay, that is well advice. I guess most of you already do. And this is the equity curve of 5 years of backtesting, of a manual mechanical backtesting between January 2005 and December 2009. We see there is a total trade total trade number of almost 300 trades. Pardon. During these 5 years, okay, 300 trades. So we can calculate. I think per currency pair there were, if I'm not wrong, more or less 2 trades per month, or between 2 and 4, something like that. Trade per week, maybe is the average per pair. And I tested this in in practically all majors. What we see here is the sterling, but I tested it on the euro, also crosses like sterling yen, dollar yen, in the Swissy, I tested it. And the majors basically is where it worked better. But I must say that since this is a breakout system, you will have a high correlation between the breakouts, okay, along the majors. So usually when a breakout happens in one pair, you have a trade on the other majors or crosses as well. So it's in that sense, it's you really don't diversify the risk. Okay, what we will talk about this, and especially in the second part where we will go into more discretionary trades based on a mechanistic approach. There you can be selective and jump from pair to trade, from pair to pair according to the conditions. So you take only those conditions that are the most appropriate ones. But before going into discretion, I wanted to know if applied mechanically, if there is a potential, if there is a profit potential with the strategy. Okay, so there is something very curious here in these strategies, that there are a lot of break-even trades. Okay, as you can see, 55% of trades were break-even. Just a brief interruption. We are now at the official end of the first part, I guess. But if you wish, we can extend it a little bit. I would ask in this case the moderators if we can extend it a little bit before going into the premium session. Let me just ask Vicky if we can do it. 1 second, please. Vicky, 1 second, please. Yes, Boyti, we would need some time in between, but since we don't have any other webinars today, this is the sole webinar. So yes, Vicky already answered me. I contacted her through the messenger. Since we don't have a tight schedule today with other webinars, what we can do is extend this one for 15 minutes more, and then we make a pause and we start the premium a bit later. Okay, so we have just a few more things to go over. So this is the statistics. I will not go into very much detail into the statistics, just to tell you that the number of break-even trades, as you notice here, I wanted to track them statistically separated to the win trade. normally a break-even trade is considered a win because you already covered the spread. So you are break-even in the sense that you could at least gain the spread. So the cost is covered. Okay, so technically it would be considered a win. But I like to, when I analyze statistics, I like to put them separately, and we see that we have a high number of break-even trades. That brings us to a win rate of 46% only. So this breakout system only wins 46% of the time. Okay, so this is a quite low number. Again, this is a mechanical backstage, so I just applied the rules exactly as they are with price action, and the results are this. But the key here is the key of the question is that we are comparing here 46% win rate, not with a 54 loss rate, but with a 35 only. Okay, because we have 90% break-even rate. So suddenly the 46% win rate becomes much more significant because the loss rate is only 35. Do you see why establishing rules to get a break-even trade is important? Not because it enhances your win rate, but because it reduces your loss rate and makes your win rate, as low as it may be, more appealing compared to the loss rate. Okay, so this is we'll go not very deep into statistics, but just I found out that this is of an interesting point. So we are here at the verification stage. Okay, so ready to go for the application of the strategy in real time. We would obviously start with a forward test in demo mode. We would see the execution, if it's okay, what type of platform would suit best for this strategy, and so on before we get into real. So then we through the forward test and first applications of the system, we get new observations. Okay, so the first observation we find out is that a confluence between the Fibonacci extension 1618 and any of the daily pivot point support and resistance levels will make the price area more significant. Okay, therefore a new rule is established. Okay, that is the pen and paper that I have on my side. I use it to write down those observations and to write down new rules. Okay, so I establish as a new rule the maximum distance between the 1618 extension and any of the pivot support and resistance has to be equal or less than 15% of the previous daily range. What we are talking here is about confluences, technical confluences. Confluence is a principle of technical analysis as well. Okay, we want to see confluences among indicators that are confluent at a certain price level in order to forecast those price levels where most traders will make a decision. Okay, because we need those levels also to make our decision. Okay, so that is how we came up with this new rule. Okay, first I tested with 10%, 20%, and since we are talking percentages here, because we are using a percentage scale Fibonacci extension to establish our target and our stop, I used also something that was a percentage in order to fine tune the confluence between those levels. Okay. So the second observation is if price doesn't reach the target the same day, the Fib levels lose their meaning. right? Because a new day established, a new open, high, low, close is established, and the Fibonacci scale of the previous day loses its meaning. So I have to readapt. Therefore, Fibo levels for take profits or stop losses will be adapted if a trade remains open for more than one day for the next day. Okay. If price loses steam and none of the limits is reached within 2 days, the trade is closed at the end of the second day. Okay, at 5 p.m. So these are observations that it's practically impossible to come up with in the beginning. In the beginning stage of the strategy, before I have any measures, before any considerations about conditions and so on. This is something that only arises from observation at backtesting. Because another advantage of backtesting is that you see the occurrence of the price of the setup you are trying to capitalize. You see the occurrence many times in a short time, so that your mind is able to memorize what is common to those setups and write down those observations. If you go in real time and you have only one signal every 2 days or so, there is so much information going through your head that the critical one, the crucial information, will be lost among all the other information, and you will not be able to to synthesize that information. Okay, so that is another advantage of the backtesting. Okay, enables you to see what is important or not. The third observation: sometimes the price stops at a pivot point, support or resistance level, and reverses, failing to hit the 1618 target by a few pips. Therefore, a new rule is set. Therefore, a new rule is established. The target will be the Fibonacci extension or a support resistance level of the pivot point, which is closer to the entry price. Okay, this is you just take the level that is closer. Okay, first you want to know that the distance between both is equal or less than 15% of the daily of the yesterday's range, and besides you take just the one that is close. Okay. Fourth observation: I have also noticed that when a pivot support or resistance level is very close to the entry point, we are likely to experiment a false breakout. Okay. Sometimes there is a small breakout just to touch an important pivot level or support or resistance of the daily pivot, and price reverses because the orders were clustered there and not at the high or low of the previous day. Therefore, if a support of this pivot level is closer than 10 pips from the entry price, okay, that level, that support or resistance level of the daily pivot will be considered the new entry level. Okay, that will be the new entry level. Okay, maybe you want to sum 1 pip or 2 above it or below it in case of going short, but we don't take the breakout at the previous day high or low. We take the breakout at that level, at that new level, because of it being very very close to it. Okay, then we are reaching the end here of the session. Just a note on what position sizing could do to our approach. Here we see this is exactly the same strategy, the same trade, but the equity curve here shows a different position sizing. Okay, in that case it is a measured fixed fractional method that we use. Okay, we'll go in a different session. We'll go over it, explaining what it is. But in the results we saw before. Okay, and that curve here. Okay, we went up from initial start balance of $2,000, and we reached finally around 8,000. Okay, and this was done with a fixed lot position sizing. I always traded the same size. Always traded the same size. In that case, there was a variance. There was a variance implied into the position sizing, and you see from 2,000, yeah, it's reached above 20,000. Okay, the same trade, exactly the same trade. So here again, we see the position sizing is another component, not of the strategy, because here we are not talking strategy, we are talking already about a system can do to a strategy. More important than the strategy, the strategy itself, what I wanted to show here is that a very simple approach and a very humble statistical record, a very humble win percentage, like 46 win percentage that we have, can, in terms of the implementation of a rule to get break-even trade, or the implementation of a position sizing model, can boost the results much further. And here again, a fixed ratio is another position sizing model. You see, it takes it practically to $19,000 from 2,000. The same period, same trade. Okay. So the lessons learned in this session, we're coming to an end. This is only by understanding the ideas behind the strategy you will be able to effectively use it to your advantage. We talked about it. The closest thing to a holy grain trading is building a strategy method from based on your own inventory, your own ideas and observations. And don't be too picky trying to find or develop the miraculous system, because that is not the point, and that no system is 100% accurate. Okay, all we need statistically is a legitimate edge. Okay, so here I would like to get maybe 5 minutes for question and answers. Surely you will have a lot of questions at this stage. We still can do it. We just prolong a little bit the pause in between the do you scalp or just swing? Harley asks if I scalp or swing. Well, the definition of scalping and swinging will be not apply to this intraday strategy. This is an intraday breakout type of strategy. I would not consider this scalp, since I don't go for a few pips, and the frequency is not typical of a scalping strategy. And a swing strategy, the definition says trades maybe remain open for days or a few weeks, and that is not the case. We just it's an intraday system where we at least are open with our trades for a maximum of 2 days. Okay. Doni Ducati asks, what will be covered in the premium webinar? Well, we will we'll do a backtesting session to see the rules in more detail. We'll apply them in real time, in a historical mode, backtesting, with a specific backtesting software, and then we'll go to the charts, and we will see how we can transform a mechanical trading approach into something more discretional. Okay, because this is the natural evolution of every trader, is to leave that mechanical stage and enter into a stage where discretion enters into action and is used is also a vital ingredient in the decision making. Okay, so that is why I said at the beginning, this is just a step. Being mechanical in our approach is just a step, because many times aspiring traders try to be intuitive, try to be artists from the beginning, and you don't get that skill once you if you don't pass through a few thousand hours of trade setup and chart reading. Okay, you need that, and the best to pass this phase is to try to apply a mechanical approach. This is the best way. You have to accumulate visual chart information in your subconscious and to try to pass that stage as to survive. I would say that stage, survive in terms of emotionally and financially, till you get to a point where your discretion starts to be strong enough to use it as a filter for discretion for a mechanic approach. Okay. Okay. Interesting question from Karim. How do you manage your trades to get break-even trades? Very simple rule. If after a breakout, okay, we have a breakout, and if after this breakout, the hourly candle, we are on a 60-minute chart, if the candle closes beyond any of the support or resistance of the pivot point, then I move the stop to break even. Okay, just that. And a candle needs to close beyond, that is above if you are going long, or below if you are going short, any of the pivot points. If you see it by the close of the 60-minute candle, then you move stop to break even. Okay, and many times we have a reversal. That's right. That's why the break even rate is so high. But it's better than suffering that loss. Okay. Harley asked because if trading when trading short term scalping, we could not reach the 1618 extension. That is right. That's correct. I remember back in 2008, I think the middle second part of 2008, where the burst of the carry trade, where we had these huge movements down in the sterling yen, for example, 900 pips in one day or things like that. This is where the system got the biggest amount of pips per trade, because everything was set up, and the prices were moving so much per day that the Fibonacci extensions were also big, because it's a proportion of it. So the profit targets for the next day were huge, and that is why it's not a scalping. It's a breakout type of strategy that adapts to the speed of the market. So that if yesterday the price moved 400 pips, so I will adjust to that, and the system or the strategy in that case will adjust to that by choosing a tool that will take that into consideration. Will take the condition of the market, and that happens with if you take the Fibonacci extension to take profit. You are taking into consideration what the market is doing in the last day. Harley says need more time to reach the extension. Yes, not only sometimes you can reach. In fact, this is something that you can observe easily. If there is a confluence between the 1618 extension, the previous day range, and one of the pivot points, support or resistance, slide to GMT, okay, then the breakout or the surge in movement is many times very fast. Then it stops there. First it stops there, then it might move further or reverse, but usually the reach of that confluence is very fast. And this is not dependent of the distance. It's not dependent of the distance. Okay. There are reasons in why not. This is, has to do with more capital flows and so on, that we will not enter into it, but it is so. Alex asks, what is the good stop loss take profit ratio for automated system? Is it okay to default at 2 to 1, or must depend on win percentage and find out by backtesting, which means a lot of curve fitting? It's an interesting question here because the in the evolution of a trader, we would at this stage where we have a we tried we designed a mechanical approach. The natural way would be for a trader now to become more discretional and do what we are going to do in the second part, or try to become automated. Okay, try to automatize it. Okay, or there is a combination of two. There is personally where I see most of the profitable traders. Combination of two. But there isn't really a ratio because the ratio first the ratio is a measure that you do before you enter the trade. Okay, and it's not the to compare with other statistical data that you get after the trade. Okay, we'll talk about this in a future webinar. But the 2-to-1 or 3-1 or 1-1, it depends. Obviously, it's in strong tandem with the win percentage, and the win percentage in itself also with the break even percentage and so on. Okay, but there are all types of profitable strategies that aim for 1-1 or even less, and simply play with different conditions. So there is not I would say, Alex, there is no fixed rule for that. Okay, but it's true that from a psychological point of view, it's easier to choose a higher win percentage than a lower, because you will be finally executing those trades. And I mean, if you can stomach a win percentage of 46%, like the one we are getting here, then it's okay. But you probably won't. I can't. So I will explain why I can't apply this strategy in real time in a mechanical way. That is why what I will explain. Okay. Thank you very much. If there are no further questions, we will close here the first part of the webinar, of the monthly webinar, and we will be back. Let's say in 20 minutes. Is it okay for you? If we are back in 15-20 minutes. Okay. So see you another time. Thanks for your time, for your interest, for the great questions, and for the huge audience and this 2010 August. And see you in a moment.